All right, what's going on, guys? Terry James, your mortgage guy, coming to you. Today, we're going to be talking about the basics of how to get your pre-approval done. I'm going to be going into more details than some of my previous videos and kind of going over the 4 steps. The 4 things are going to be the credit. We're talking job history. We're talking debt to income, and then cash on hand. So these are going to be your 4 major things when you're applying for a loan, when we're talking to lenders, big banks, no matter where you're going for your loan. These are the 4 major things that impact your loan and that help you get pre-approved. All right. And so typically when we go into credit, a lot of people, first, start to cringe, feel some kind of way, anxiety, feel bad at the mention of credit. So just to kind of get into that, there are essentially, when it comes to your credit, first going over credit score, typically you're able to get pre-approved somewhere around the 580 score, middle score, and then your 620 middle score. And when I say middle score, what that is, that's referring to the 3 credit bureaus. You have Experian, Equifax, and TransUnion. And then your middle score is going to be exactly what that says, the middle score of those 3 credit scores. Okay. And so what they provide you is typically that middle score has to be at least 580, 580 to 620, depending on the lender, which really isn't going to be much. I know, you think you have bad credit, but these are the things that will help you with your credit. And we're actually going to break into the parts of credit, what to really look for and how to start building that up. Okay. And so when it comes to your credit, we're talking 5 major areas that affect your credit score. Okay. So we have your payment history, which is going to take 35%. So 35% of your credit score is based upon one simple factor, which is your payment history. And what that is simply paying your bills on time. Okay, so that's, making sure everything gets paid on time, no late payments. And the thing with the late payments is they're not talking, if your bill is due on the 10th and you pay it on the 15th, that's not considered late in the eyes of credit. So when it comes to credit, your late payments are anything past 30 days. And that's when it's considered to be late on the credit. And that's when you'll see a late payment actually affect your credit. So when we say on-time payment, that just simply means making sure your payments are paid on time within that 30-day period of when it's due. All right. And so one of the things that we can do, especially with all of our smartphones and everything going on, we have our tablets, we have our, computers, everything like that. What you can do to help with that, to make sure your payments get paid on time, is just simply set up an auto pay. Okay, so if you set up auto pay, you make sure your credit cards get paid on time. Any of your bills you have, whether it's student loans, auto loans, making sure all those get paid on time. That's going to make up 35% of your credit score. Okay, the next largest box, which makes up your credit score, is going to be the amount of debt that you owe. Okay, so that's talking your total balances of everything that you owe. So your total balances of everything you owe makes up 30% of your actual credit score. Okay. And so on there, then we also got to segue into and talk about real quick is utilization. Okay. So what that means is that the utilization is going to be your balance versus what the balance is, meaning your balance on that credit versus what the actual credit limit is. So if you have a credit card and you have a balance of $2,000, a limit of $2,000, and then your actual balance is 1,000. Okay, so that automatically that puts you at 50% utilization. Okay, so your utilization it's recommended that it be at 30%, is typically what everyone is going to say. But as an expert in this field and someone who's been doing this a long time, you actually want to keep your utilization at 10%. So, and when I say keep it at 10%, I don't mean get your balance at 10% and just leave it there. No, what I mean is you want to run that balance up to 10%. You want to pay that 10% off every month. And that's when you'll see and get the biggest benefit that will boost your credit is getting it at that 10%, paying it off every single month at that 10%. And that's when you'll start seeing a huge boost to your credit. Okay. The next factor is going to be length of credit. Okay. So your length of credit accounts for 15% of your credit score. Okay. So 15% of your credit score is made up by the length that you've had credit accounts, student loans, auto loans, whatever that might be. Okay. Now, the length of credit, what I would tell you is that right now, if you know that you're going to be purchasing a home, or if your plan is to purchase a home in a year, whether it be 6 months, whether it be next year, whether it be 2 years, the first thing you want to start doing is building that credit. So what that means is you have to start applying, you have to get credit cards, you have to get auto loans, you have to apply for those things, and you have to start getting accounts to help your credit because that length of credit makes up 15% of your actual score. So typically, everyone says don't add credit. Listen, so you don't want to apply for credit cards if you are in the middle of a transaction, if you are buying right now. Do not take this part, okay? This is for when you're preparing to purchase, okay? So you're a year down the line, you want to start building your credit. This is what you want to do. You want to apply for credit cards. And the credit cards you want to get, you don't want to get the Target accounts, the Best Buy accounts. Those kind of accounts are not going to give you the best bang in the sense of, kind of where the credit bureaus look at your credit and they give you the highest rating. The credit cards you want to get are going to be from your bank. You want to apply for credit cards with your large banks that you have, your credit unions. You want to apply for credit cards through the actual, Credit One, like all these different type of, large creditors. Those are the ones you want to apply for credit, and you want to hold those credit cards. Okay. And then, like I said, apply what I previously said, which is keeping it at that 10%. But the next factor that applies for 10% of your credit score is going to be your new debt. Okay, so your new debt is the one that, what that means is that anything new you have, that's when it's going to affect your credit score. Okay, so your new debt, when you just get a new auto loan, it makes up 10% of your credit score. And the new debt is something because it's saying, hey, you're getting new credit, you're paying for it, you're being on time, you're being responsible. Those are all good things. Once again, it only makes up about 10% of your credit score. All right. The next thing is going to be a mix. Your credit mix is going to make up 10% of your credit score. Okay. Now, when we say mix, what does that mean? The credit mix is going to be talking about as far as like auto loans, student loans, mortgages counts as a mix, credit cards counts as a mix, personal loans count as a mix. So we're talking the mix of what you have on your credit. So if you have just credit cards, you want to get an auto loan in there if you can. So you just want to have a variety of debt because it looks better with the credit bureaus are going to give you a higher score based upon that. And then when it comes to applying, you'll notice that your scores are going to be in a better position as well. And the same rules apply, which is make sure you pay on time and try and keep everything at that 10% utilization. All right. So that's going through credit. So it's not something that we have to be afraid of, but the more we know about it, the more comfortable we can be and the more that we can start to manage it. A lot of the times that when it comes to credit, we just don't know. So therefore we don't know how to use it. So of course, in order to get a credit score, you have to have credit. Okay. So I know many people have tried to, purchase a home and they don't have any credit cards, you don't have an auto loan, and you come in and you're like, hey, great, I'm good, I have perfect credit. Well, you don't because you don't have credit. So that's the first thing, we have to know how to use it Everybody has credit. If you're going to get a mortgage, if you're going to do these things and start investing and even start getting your financial future in order, you have to have credit. So credit is not a bad thing. You just have to know how to use it and how to be smart with it and how to use it for your benefit and not the credit card company's benefit, or the auto loans benefit. So you pay that stuff down, you pay on time, and you use it for your benefit. All right. So the next thing to get pre-approved, once you have your credit score over that 580, that 620 mark. And then, like I said, so just to go back into the credit score real quick, when we're talking about scores and rates and how that affects you, so you can get pre-approved and you can buy a home at the 580, 620. But what's going to affect and what's going to matter now is going to be, okay, well, what kind of, rate are you going to get? How does that affect your down payment? So all those other factors are going to come in. But if you have a 580, you have a 620 credit score, that will get you in the box of getting approved for the home loan. Okay, there's other factors there, but that will at least start you on that way to get you approved. All right, the next thing to work on your pre-approval and to get you pre-approved is going to be job history. Okay, now everyone thinks that you have to work on your job for 2 years and that you have to be on the same job for 2 years. That's not what that is. So when we say job history, what you're looking at is going to be, first, if you're a W-2 employee, we're talking 2 years of work history. Okay, so you have to have stable income or history for 2 years. Okay, and then any gaps that are typically larger than 30 days, you're going to have to explain those gaps and say, okay, well, why were you not working for those 30 days? All right. So the main thing is going to be the 2-year work history. If you get paid bonus and commission, you're also going to have to prove or show that you receive that bonus and commission for 2 years. Okay. So, let's say you get a job, you're a W-2, and now you have a job where you're getting paid bonus or you're getting a commission now. That commission income more than likely is not going to be able to be used unless we can show that you use or that you received a bonus or commission for the previous 2 years. So we're talking W-2s, year-to-date pay stubs for the previous year to show that bonus and to show that commission income. Okay. And then when it comes to self-employed, if you're self-employed, you're going to have to show those tax returns or corporate returns. If you're more than 25% owner in a business or LLC, you have to show those 2 years of returns because they want to make sure that the job history and that your income is stable for 2 years. All right. So that's real quick on the job history part. And like I said, if you ever have any questions, make sure you hit the comments. Make sure you also subscribe to the video, to my channel, and make sure you check it out later. And then when it comes to the next portion is going to be your debt to income. Okay. So the next thing is going to be debt to income. And what does that mean? So, people hear that and you're like, okay, well, what's included in the debt? Like I said, I've done other videos, but I want to go a little more into detail of that. And you can always check out my previous videos, just to get more information on that. But the debt to income, what they're looking at is not going to be, your PG&E bill. It's not going to be your car insurance. What's included in your debt to income when it comes to the lending side and getting pre-approved for the home, you're talking, what's going to be included as far as your credit card, monthly payment, your student loan payment. Even if you're not making it, you're going to be held for that 1%. The other thing in your debt to income is if you have any judgments, liens, anything like that, court-ordered stuff, alimony, spousal support, anything like that is going to count against your debt to income ratio. And how you figure that out is real quick and simple. You add up what you have on a monthly basis. You divide that by your gross monthly income, and that gives you your debt to income ratio. Okay. So if your expenses every month, if we're talking credit card bills, auto loans, stuff like that, that reports on your credit or court ordered, you're going to take it up here. let's say it's $1,000, you're gonna $1,000. Your gross monthly income is going to be 4,000, just for example. You divide that, and that gives you your debt to income ratio. Now, of course, you have to add in your mortgage payment when applying for the home to see what your debt to income ratio is going to be with the mortgage payment. Okay. But that gives you the breakdown of what you need. Now, that percentage, when you go back, that percentage for FHA loans to get approved typically is going to be 55%, usually somewhere around there as far as on the FHA side. Conventional, you want to stay within that 45% total range. However, on conventional loans, as I've said before, 36% for the mortgage payment is where your debt to income ratio needs to be on the front end for the mortgage payment only, but your total usually for conventional is going to be, you're going to be capped at around that 45% mark. For different loan programs, you may need to be at 42, 43%, depending on the lender. So if I would you, I would play it safe and stay around the 43% mark for conventional. Okay. And so the last thing that number 4 on the list is going to be cash on hand. Okay. So all that simply is how much do you have for your down payment? How much do you have for your closing costs? The banks and lenders are always going to ask for, your cash on hand. How are you going to pay your down payment? How are you going to pay your closing costs? Okay. Because you can't get approved for a loan if you don't have the money to pay for it, and you can always get a gift. But the other thing that affects your approval is going to be, okay, well, how much cash do you have? So if your down payment is $30,000 and you're getting a gift for $30,000, well, that's all great. But you can't get approved because you still have to show you have money for cash to close. So you're going to need the money in bank statements. You are not able to use mattress money. The money has to be able to be documented. It has to show. And you have to be able to show the bank as far as statements where the money came from. It's going to have to show as far as deposits. Large deposits may have to be verified, but your cash on hand is what's going to be the fourth part of what everybody and every lender, every bank, no matter where you go through for a home loan, that's what they're going to look for. All right. So I hope this has been helpful. Make sure you subscribe. Make sure you hit the like button, and so you can get all the other videos that are coming out. All right. You guys take care. Talk to you later.